All right. So we need to understand the entity. So we've actually said that. The reason why we want to understand the entity is that it will help us to identify and also assess of material misstatement, which we've stated here. Okay, not only that, it is also going to enable us design and perform our audit, because your knowledge leads you to your planning. Okay, design and perform the audit procedures. That is why you need to understand the entity. And understanding the entity gives you actually your frame of reference for judgment. Because when you are even interpreting ratios, you need something to be a yardstick to judge with, a frame of reference for judgment. In some industry, there are specific ways things are done. Okay, so when you step onto the field and you really understand the entity and its industry, you actually realize that, okay, so this is how things are done. You actually have some yardstick, a point view of how you are going to understand and also give judgment to certain things. All right, so that is that. So in the industry, in petroleum industry, for instance, per experience, even a 5,000 Ghana cedi, 100,000 Ghana cedi seems immaterial. Okay, it seems immaterial. But in some other industry, 100,000 Ghana cedi is actually very material. So the industry in which you are helps you to frame or reference some things in terms of determining what is material or what is not material. Okay, so that is what we are actually trying to talk about. Now, we say understand the entity, and so not only did I say understand the entity, I also said that the second thing you need to do is the areas of understanding. What to understand? What to understand? What are you understanding? The areas of understanding, we've talked about the entity. So this is it. We have the entity. Then we are also saying that understand the market. The market, I've already touched on that. I've said the industry. Okay. You have to know the competition around, because if you don't even know the competition, you are not able to assess conflict of interest. You need to know. You need to understand the business risk. The business risks. You need to understand. You need to understand the accounting procedures. The accounting procedures. The depreciation policy applied for that industry. You need to understand how estimates are derived in that industry. You need to understand all those things. You need to understand the technology used in the industry. Yes. Any question? Any question? All right. Without such, not only do you need to understand the market and the industry, economic factors come to play. Economic factors, of course, especially in Ghana. You need to know government policies for the industry. You need to know the government policy. You need to know inflation. and interest rates, especially in Ghana. Need to understand all this, and the currency control, exchange rates. Okay, these days the exchange rate is making petroleum sector suffer a lot. The Russia-Ukraine war is making this sector suffer a lot, because you all know that Russia was actually coming up with fuel. All right, people in this part of West Africa were actually looking up to that side for importing crude into the system, and even finished products into West Africa before this war popped up. And the last thing probably we need to get to understand is also the reporting framework. Okay, the reporting framework. When I say the reporting framework, what I'm talking about is legislations. All right. If you encounter money laundering, where do you report to? You need to understand all those things. Okay. You need to understand, you, the auditor, your requirements, the audit requirements. You need to try and understand all audit requirements. All right, taxation and all those things around it. You need to really, that is what we mean. Okay, so understanding the industry, the entity itself, the nature of the business of the entity. Okay, this one, the entity itself. This one, we talked about the reasons for understanding. This side is for reasons. Why? Why you need to understand it answers the question why. That is what you see here. Here we are talking about what you need to understand. All right. So what do you need to understand in the industry? What do you need to understand about the entity? You said that the entity, you have to understand ownership. You have to understand those who control the board of directors, need to know them. You need to also know if the company is in retail, wholesale, manufacturing. You need to know financial services, import, export, you need to know, okay? You need to know operations, location, where they are, employment, everything, their debtors, their payable, their inventory, their bankers, how their capital structure is, all those things you need to know. You need to actually know, okay? That these are things that you have to know, okay? And other things that you need to also get on board in terms of getting to know more about the company, which I've earlier pointed out, okay? The business risk is very, very important. The business risk. Later on, when we are talking about audit risk, you understand them more. Other things also includes the internal control processes and all those things. Where do you source this knowledge in terms of getting to understand? Where do you source them? If you want to know about someone, where do you source the knowledge? Of course, somebody has audited the client before you might actually start. So we say that you can use prior period knowledge. Prior period knowledge. You can take the audit file of the client. If you are the same entity, that audit firm that did the audit, you can take the same thing and you can actually work on. All right. Then if you want more information, so we said that prior period knowledge. We are also talking about, you have to use enquiries. Okay. Now you can ask management about any information that you want. You can also ask other people in the entity. Okay, that is it. You can also use observation method. See, let me tell you something. Later on, we will bring it back in terms of gathering evidence. But whenever you are asked in audit how to get any information, any knowledge, anything, how you get it, you should never forget things like enquiries. We will come to that, the vowels. We will come to that. We will use the vowels to talk more about that. But if you want to know anything, you can sometimes observe. Not only observation, you can inspect. All right? You go to the client's office, you visit them, you use visits, you kind of observe what is going on, all right? And as the team members who are going to the audit, you can also hold a discussion. Among you, the team members, so that you can get more knowledge. Another source is publications. These days, every company has a website. If you want to know about the company, you can go to their website, all right? That is that. When you now source this knowledge, you understand the knowledge, able to assess risk. So in the nutshell, you are going to use this knowledge to identify risk. The reason why you are using this knowledge is to identify risk. That is the major reason why we say understand, KYC, anything. If you do KYC, you are able to identify risk like money laundering, all those things. You need to identify a risk, all right? Then when you identify the risk, you need to assess the risk. All right? Whether the risk that you have identified are pervasive to the financial statement. What is the relationship? So here, in terms of risk, assessing the risk, we are saying that what the relationship of the risk to the financial statement. Of the risk identified to the financial statement. That is what we are saying, because our major objective as external auditors is to the financial statement. So when we are assessing the risk, we will see, we want to really check whether the risk is pervasive to the financial statement as a whole, all right? Okay, so now, once we are able to assess the risk, we now relate the risk. Okay, so we say that, I mean, at this point, what can go wrong at the accession level? We will come to accessions, all right? So relating the risk help you to know more about the controls that are in place to address this kind of risk, okay? If you assess it and it has some link to the financial statement, what are the implications? All right, then the last thing you do after relating the risk is to evaluate its materiality. Is it material that can cause us to say the financial statement is not true and fair? We need to know that. Okay. Now that you have understood this, let me now move directly to audit risk, because everything that we are doing in terms of understanding and everything is leading us to risk. So let's look at audit risk, risk-based audit. Risk-based audit. And we are going to look at audit risk. Now, what is risk-based audit? Risk-based audit is an approach to audit whereby the auditor only concentrates The auditor concentrates on high risk areas, okay? High risk areas, because the job of the auditor is to express an opinion, all right, as to whether the financial statement in all material respects is true and fair. So the approach that they adopt, that one of them is risk-based audit. Now, in this risk-based audit, he is going to concentrate on the major areas where there are risks. After understanding the entity, there are major areas where you know that, oh, okay, if there is a high risk at this part, it is going to affect the financial statement, but in a very material manner, and so can cause the auditor to modify his opinion. All right, so the concentration in an audit-based approach audit, risk-based approach audit, is for the auditor to concentrate on areas where there are high risk, okay? And that one will help him to, develop his opinion and attack his audit strategy. That is what we are talking about. So as opposed to detail doing everything, trying to do everything 100%. No, the auditor actually looks at only places where risk are prone to happen. Now, in terms of risk-based, this risk-based approach, so like we are saying, the auditor is actually looking at the audit risk. Now, what is audit risk? Audit risk simply means that the risk that the opinion of the auditor will be wrong, all right? You know, the auditor says that the financial statement is true and fair. What if they are not actually true and fair? Okay, so the audit risk simply means that the risk that the uncertainty, the risk or uncertainty that the auditor or the auditor's opinion will be wrong. Haven't we experienced this that much? How many companies has been closed down that weren't audited? So they all, in those financial companies, it was said that they were all true and fair. How come they were closed down? How come they were closed down? So, they were all audited, but they were closed down. So it means that the financial statement was actually probably not true and fair. The auditor said it's true and fair. So the risk that this auditor's opinion might be wrong is what we term as the audit risk. Okay. Audit risk comes from two main sources. So the first part is actually the company, the entity itself, and that part is risk, is what we call risk of material misstatement. Risk of material misstatement. It means that the entity itself, in getting the figures to form the P&L and the statement of financial position, might actually have done something risky, all right, that makes faithful representation not being achieved. Okay, so that is that. It is coming from the company itself. Now, if the company makes a mistake, which is material, it is the job of the auditor to see it, okay, and form his opinion on it. So not only is the risk just about the entity's mistake, it is also about the auditor not being able to spot it, okay? The auditor not able to spot those misstatements or to see those misstatements, those material misstatements. Okay, so if they made it, then the auditor is supposed to see it. If they made a mistake or they did some fraudulent activities and the auditor did not see it, the basis of his opinion will actually be wrong, okay? So that is the main reason why the auditor needs to really understand all those things we talked about, okay, under ISA 200 and ISA 315. Okay, so that is that. Now, this risk of material misstatement can be split into two, okay? Because number one, the truth is that, well, the company made a mistake because of the nature of the company, because things happen like that in that industry, because of the nature of the company. In plenty companies, right? It happens like that. It happens like that. I mean, because of the way things are done in the company, it is very likely that there will be risk that the financial statement will be materially misstated, okay, because of the nature. And this one, we call it inherent risk. Inherent risk. Inherent risk. Okay. Now, if you're a company, you have these kind of weaknesses because of the nature of the company. You are expected to, through corporate governance, come out with control system to take care of these things. Okay. And if you don't, that one leads us to what we call weak internal controls. Weak internal controls. You are supposed to have controls set up according to corporate governance, all right, to deal with these ones. And that is what we call control risk. Control risk. Control risk. Okay. Then the auditor is supposed to spot all these risks happening, right? So on his part, what we are saying is that he's supposed to detect them. So we have what we call detection risk, whether he's able to detect it or not. Okay, detection risk. All right, he is supposed to, via his substantive and analytical procedures, be able to spot all these weaknesses of the company. Substantive and analytical procedures. Okay, procedures. To spot all these weaknesses and these inherent risks. All right, so his part is called detection risk. So audit risk is equal to inherent risk plus control risk plus detection risk. Okay, so that is the mathematical angle of it. Okay, so if you have an inherent risk, you have to have a control to deal with it. If you don't, it means that the auditor who is doing the job must be able to spot it, okay, and report on it. And that is his detection risk as to whether he is able to do it. And that thing is going to come from the sampling techniques that he will be adopting. All right. So when we get to the other side, we experience it. Okay. Now, inherent risk is just telling us about the likelihood that because of the nature of the company, there will be risk, and this risk, so we are saying that the company is susceptible to risk because of the nature of the company. And because of that, transactions may be affected. So we are talking about these things affecting the class of transaction because of the way transactions happen. Sometimes cumbersome transactions, speedy transactions. Some of them are cash-based, some of them are check-based. So it's likely that the people will be embezzling funds and all those things. So we are actually talking about the class of transaction we are talking about some disclosures. Will they be done? Will all disclosures be done? And all those things. account balances, and all those things. Now, these risks that we are talking about here are affected by majorly the integrity of the client, the integrity of the client. The people charged with governance, the board of directors, is majorly affected by that. If they don't have a proper setup, if they themselves are not having integrity that much, all right, it is very likely that there will be some risk inside the entity, all right? Now, if they are not committed to ethics, in fact, their experience alone, management experience, if you have a company where those who are managing it don't really have experience about how the company is supposed to go, there will be risk. And that alone is just because of the nature of just because of the company. If they do practice more corporate governance, a proper corporate governance, you won't be seeing so. And mind you, the thing that happens in office finally ends up in the financial. If you have management who chop monies, who are not having integrity but chop monies, it is going to affect your financial statement. If cash is going out, definitely it ends up in your financial statement. So that is what we are trying to talk about, right? That is what we are trying. Unusual pressures on management and all those. If in the company you see high labor turnover, you will see that there will be inherent risk just because people are leaving the company. It affects even the financial statement. All right, that is it. That is it. Okay, now let's look at control risk. In control risk, we will actually be talking about internal controls. Okay. Now, it is the duty of the management, to detect. It is their duty to prevent. It is their duty to correct risk. That is majorly due to weak internal controls. Weak internal controls. Okay, for example, let me give you a typical example. You all know about bank reconciliation statement. If bank reconciliation statement is not performed in the entity, you will see that the more it is not done, certain things might be going on in the cash book and the bank statement that you may not realize. All right. And that one will lead you to having certain things in your financial statement not correct. As a matter of fact, how do you even prepare your monthly account without your bank reconciliation statement? If you don't do it, an expense might not be posted. It will affect the materiality of your financial statement. All right. So controls are very, very key. Controls are very, very key. We will later talk about internal control, and you will see the components of internal. All right. But this bit, we are actually talking about auditor sampling techniques and knowledge about the standards. Knowledge about the standards. All right. So that is that. So how does this look in terms of your examination? How does it look in terms of your exam? In terms of your examination, you'll be given a case study. All right. And this is where the audit is actually about. This is what audit exams is actually about. So in your case study, you will see that there are issues that are cropping up that will make you see inherent risk happening. So you will see the risk. You will see that management don't really have control set up to deal with those kind of risks, to prevent, detect, and correct these kind of risks. But it is you, the auditor, to spot it. Let me give you a typical example. Let's discuss this. So inventory in the books say was stated at 25,000 as at the end of the year so 2021, but was subsequently sold at, say, 15,000 on January 15th, 2022. What can you tell me about this? So they have inventory. It is stated in their books, this closing inventory stated in their books at 25,000, but this inventory in January 15th, 2022, I mean, just the next year, was sold at 15,000. And this is what they have done in the financial statement. What can you tell me about this? What is wrong with this? Or is everything correct? What can you tell me about this? Yes, anyone? Anyone? Hello, anyone?
Hello, sir. About what? I just joined.
Yeah, this is it. They have inventory stated in their books. 25,000, but those inventories were as at the end of the year, it was stated in their books at 25,000. Okay, the company's book at 25,000, but was subsequently sold just the 15th of the next year, January, at 15,000. And I'm asking, what can you tell me about that? What do you see wrong? Or is everything correct? What do you see wrong? So they have closing stock stated as 25,000. Those closing stock was sold later the next year at 15,000. What do you see here as accountant? What do you see? What do you think should be done? Because this is what you are going to face. Oh. This is actually what you are going to face. Yes, any thoughts? Any thoughts?
So it means they've
Yes, go ahead.
it was so below the price bought it.
Yeah, so what will you do about it? Yes.
So it means it's a, should we say it's an understatement?
Discount to be granted for prompt payment. Okay. All right. So you see, I always tell students that audit is a combination of FR, CR, and the audit technique itself. Now, if you are so abreast with your standards, and please, that is how your exams is going to be. So they will actually tell you, give you something, and tell you what the entity has done. You, the auditor, is supposed to make some kind of corrections. Okay. Now you see that if you have closing inventory of 25,000 stated in your books, but just subsequently, this one was sold for 15,000. This one is a combination of IAS 10 events after financial reporting date.
Yes.
and also IAS 2, since it is talking about inventory. Now,
Okay.
what do you know about IAS 10? IAS 10 talks about events, favorable or unfavorable, that happen between the end of the financial reporting date, this one, and the date financial statements are authorized for issue, which means that if it is this date falls inside between, so it means that this is an event that happens in between those two periods. And now the standard went forth to tell us that there are two events: adjustable events and non-adjustable events. Adjustable event gives evidence of something that existed before the end of the financial reporting date. This one, 25,000, existed before the end of the financial reporting date. And it goes on to say that adjustable events must be adjusted. All right. Now, when you come to IAS 2, IAS 2 tells you that inventory should not be stated over their recoverable value. So it says that the lower of cost and net realizable value. Now, you see, the net realizable value is the value that you are going to get when you are selling the asset. All right. So this one, if you have this seated in your financial statement, and this is the actual realization of it, it means that you need to pass an impairment of 10,000, okay, to reduce this 25,000 to the 15,000. You cannot keep this 15,000 in your books. So the auditor, because of the nature of their entity, you have seen this transaction. Control here, later on you will see, we will talk about internal controls. And one of the key things about internal controls is staff. This one, if you have a staff who is a chartered accountant, you should be able to spot this and put this 15,000 in the books. So because they have control risk, they might not see this. But you, the auditor, if you remember, you said that an auditor should be an accountant under the Act 1058 of the ICAG Act. Okay, you are an auditor, you are an accountant, you are supposed to know this. All right, so your knowledge about the standard should be able to make you correct this. If you are not able to correct this, it will lead you to an audit risk, the risk that your opinion is wrong because it is not. So this is what you are going to face in your exam.